Good afternoon. Today we are here to talk about the portfolio positioning after the Q1 results of FY17. In our last strategy note, we had discussed that large caps are better positioned right now compared to mid caps, and we prefer large cap value over large cap growth. So in that respect, we have seen results being broadly in line as far as Nifty is concerned. Large caps earnings were surprises and misses were more or less in line as to what the consensus and our estimates were. As such, we saw Nifty EPS staying around at 480 levels at consensus level. So from that respect, we would say there were not much of a disappointment as far as results are concerned in this quarter. We also saw some pressure coming in the earnings of growth companies as far as pharma and IT are concerned, where we are underweight. We are also our hypothesis of value outperformance or value oriented sectors showing growth also materialized in this quarter. We saw decent results from SBI. We saw good results from the auto stocks. We saw good results from cement, more or less. So we feel that going forward, although in a valuation perspective, whereas Nifty is still trading at one sigma above its long-term average, the sectors where the valuation is still in favor or rather not picked out could be the way forward. So we feel right now, since our last update, we had included Reliance, Tata Steel, and increased the weights of ICICI Bank and Axis Bank in our model portfolio, whereas decreasing the weights in pharma sector. We feel we are going to stay in that position for the moment, and we'll see and take portfolio changes, calls on portfolio changes going forward after we have much more visibility on where the earnings growth is going to come from for this FY17. Largely right now we are playing the consumption story, which is going to expect to play out from end of Q2 and Q3 onwards. We are also expecting the benefits of the green shoots of coming from a good monsoon that had happened across geographies. And let's hope that inflation comes down from these high levels. As far as inflation is concerned, this is a upside risk or rather downside risk to a call. But right now our economist doesn't expect any rate cuts further going forward. So probably inflation or rather interest rate oriented stocks may not be the flavor anymore at this juncture. Let's hope that consumer demand comes back because right now in a market cap to GDP basis, Nifty is still lower than what its long-term average is. So we feel if improvement in capacity utilization happens because of household expenditure and government expenditure, capacity utilization improvement will show much more in large caps, and which is why although the large cap growth estimates and index level is quite comparable to mid cap growth estimates, because of the valuation differential whereby large caps are undervalued compared to mid caps, large caps will be much more safer to play from this point onward. Thank you.